A 69-year-old retired postal worker in Michigan opened his bank account on the first Wednesday of July and found exactly what he expected to find: his Social Security deposit, his pension transfer, his account balance looking the same as it had looked every month for the past 4 years. What he did not find, what he had no way of knowing to look for, were the 3 specific changes that had quietly taken effect on July 1st of 2026 that were already affecting how much of that money he was actually keeping. Not how much was coming in, how much he was keeping after the adjustments, the deductions, the premium changes, and the new fee structures that nobody had sent him a letter about. He was not behind on anything. He had not missed any deadlines. He was simply living inside a financial picture that had shifted around him without his knowledge, the way it shifts around millions of seniors every single July when policy changes take effect and the people most affected by them are the last to find out. By the time most seniors discover what changed, they have already lost the window to do anything about it. My name is Mason Parker. I track the policy shifts, benefit adjustments, and rule changes that affect senior finances specifically. The ones that go into effect on a specific date, affect a specific group of people, and almost never get covered in a way that is actually useful to the seniors living inside them. What I am covering today is time sensitive. 3 money changes that are active right now in July of 2026. All of them affecting seniors receiving Social Security, Medicare, or retirement income, and all of them creating a window where taking a specific action in the next few weeks produces a materially different financial outcome than waiting until August. Before we get into all 3, subscribe right now and turn on the notification bell. Next week, I am covering a Social Security rule that affects anyone who claimed benefits before their full retirement age and assumed the decision was permanent. For a specific group of seniors, it is not, and the window to act on it closes at a specific age that most people pass without ever knowing the option existed. Subscribe now so that video reaches you in time. Here's the context you need before we get into the 3 specific changes, because understanding July matters requires understanding how the federal benefit and tax adjustment calendar actually works. Most of the rule changes, threshold adjustments, and policy updates that affect senior finances do not take effect on January 1st the way most people assume. A significant number of them take effect on July 1st, the start of the federal government's fiscal second half, or on dates that are tied to specific processing cycles inside the SSA, the IRS, and Medicare that run on their own separate timelines, completely independent of the calendar year most people are tracking. What this means in practice is that a senior who reviews their financial situation carefully in January, confirms everything looks correct, and then does not look again until the following January has a meaningful chance of missing adjustments that took effect in July and that have been affecting their account for 6 months by the time they notice. The 3 changes we are covering today all fall into that category. They are active right now. They affect a large number of seniors, and for 2 of the 3, there is a specific action available right now in July that is not available in August, not because the program closes, but because processing timelines make July filings materially more beneficial than August filings in terms of when the financial impact actually reaches your account. The first money change involves the Medicare Part B premium adjustment that took effect on July 1st of 2026. And specifically, the appeal process that makes this month the most financially valuable month of the year to act for a specific group of seniors. Here's the background. Medicare Part B premiums are calculated using your income from 2 years prior. The premiums you are paying right now in July of 2026 are based on your income from 2024. This 2-year look-back system is called the Income-Related Monthly Adjustment Amount, IRMAA. And it creates a specific and significant problem for seniors whose income has decreased since 2024 for any reason. If you retired in 2025 after earning a full year's salary in 2024, the SSA does not automatically know your income changed. It is still calculating your Medicare premium based on your higher 2024 income, which means you may be paying a Medicare premium surcharge right now, a surcharge that is being deducted from your Social Security check before it ever reaches your bank account based on income you are no longer earning. The standard Medicare Part B premium for 2026 is $185 per month. The first-tier IRMA surcharge adds $74.20 per month on top of that for seniors whose 2024 income as a single filer exceeded $85,000. That is an additional $890.40 per year leaving your Social Security check before you ever see it. Higher income tiers carry higher surcharges, reaching into several $1,000s per year for seniors in the upper brackets. The form that addresses this directly is called the SSA-44. It is 2 pages, available at ssa.gov, and it allows you to request a premium recalculation based on your current income rather than your 2024 income if you experienced a qualifying, life-changing event since then. Qualifying events include retirement, the death of a spouse, divorce, a significant reduction in pension or investment income, and the loss of income-producing property. If any of those circumstances apply to your situation, filing the SSA-44 in July of 2026 means that if your appeal is approved, the reduced premium takes effect within approximately 60 days, meaning your September Social Security deposit could be meaningfully larger than the one arriving this month. Waiting until August to file pushes that potential adjustment into October at the earliest. The form is the same either way. The processing timeline is what makes July the month to act. The second money change involves a specific update to how the Social Security Administration is processing earnings record corrections in 2026, and why this particular window matters for seniors who have been receiving a lower monthly benefit than they are actually entitled to without knowing it. Your Social Security benefit is calculated using your highest 35 years of earnings. The SSA pulls those figures from your earnings record, the official government file that tracks every dollar of wages ever reported to your Social Security number throughout your working life. The problem is that earnings records are not always accurate. Employers make reporting errors. Data from older employment records, particularly from jobs held in the 1970s and 1980s, was not always transferred cleanly into the SSA's digital systems. Self-employment income, part-time work, and earnings from jobs held under a name different from your current legal name are among the most common sources of missing or incorrect entries. If any year in your earnings record shows a lower amount than you actually earned, or shows zero earnings for a year when you were working, your monthly benefit has been calculated using a lower baseline than it should have been. Every month, since the day you first claimed. The SSA does not automatically audit earnings records for errors after benefits begin. That process is entirely opt-in, entirely dependent on you requesting and reviewing your own earnings record and filing a correction if you find a discrepancy. Here is why 2026 specifically matters for this process. The SSA updated its online earnings record review tools in early 2026 in ways that make discrepancies significantly easier to identify than they were under the previous system. The comparison interface now shows your reported earnings alongside IRS wage data for the same years, flagging years where a potential discrepancy exists rather than requiring you to identify them manually by memory alone. Accessing your earnings record takes approximately 5 minutes. Log into your My Social Security account at ssa.gov and navigate to the Earnings Record section. Download or print the complete year-by-year breakdown. Look specifically for any year where the earnings listed are significantly lower than you know you were earning at that time, or any year that shows zero earnings when you were employed. If you find a discrepancy, gather whatever documentation you have for that year, a W-2 form, a tax return, or a letter from a former employer, and contact the SSA at 1-800-772-1213 to file a correction request. If the correction is verified and your earnings record is updated, the SSA will recalculate your monthly benefit based on the corrected figures, and the higher payment will take effect going forward. Before we get into the third money change, which is the one with the broadest impact and the one that most directly affects seniors who have never thought of themselves as being in a position to benefit from a tax filing adjustment, subscribe right now if you have not already. Every week on this channel, we cover the specific changes, forms, and filing windows that affect senior finances in ways that are almost never explained clearly in mainstream coverage. The seniors who watch regularly are the ones acting inside these windows instead of finding out about them after the window has already closed. Subscribe now and turn on the notification bell. The third money change is the one that affects the largest number of seniors, and the one that most consistently goes completely unclaimed, because it involves a tax filing step that millions of seniors have been told either does not apply to them or that they already handled correctly, when in most cases, neither of those things is true. It involves the enhanced standard deduction that became available to seniors over 65 as part of the tax provisions that took effect in 2026, combined with a specific amended return window that is open right now for seniors who filed their 2025 taxes without claiming it. Here is what happened and why it matters. As part of a broader federal tax package, Congress included a provision that increases the standard deduction for taxpayers who are 65 years of age or older. The additional deduction amount for a single filer is $1,600 for the 2026 tax year. For a married couple filing jointly, where both spouses are 65 or older, the combined additional deduction is $3,200. This deduction reduces your taxable income dollar for dollar, which means it reduces the federal taxes you owe by the deduction amount multiplied by your effective tax rate. For a senior in the 12% tax bracket, the additional $1,600 deduction reduces their federal tax bill by $192. For a senior in the 22% bracket, the reduction is $352. These are not enormous numbers individually, but they are real dollars that belong in your pocket and not in a federal tax account. And they are being left on the table by a significant number of seniors every single year simply because the deduction was not applied correctly. Here is the July-specific element of this change that makes acting now materially different from acting in September or October. The IRS processes amended returns, the Form 1040X, that allows you to correct a previously filed return and claim a deduction or credit you missed in the order they are received. Processing times for amended returns in 2026 are running approximately 16 weeks from the date of receipt. A 1040X filed in July of 2026 will be processed, and any resulting refund will be issued before the end of this calendar year in most cases. The same amended return filed in October will almost certainly not result in a refund until well into 2027. If you filed your 2025 federal tax return and your tax software or tax preparer did not specifically apply the enhanced 65 and older standard deduction, the 1040X is the form that recovers that overpayment. It is available at irs.gov. It can be completed and mailed without professional assistance in most straightforward cases, and filing it in July rather than waiting until fall is the difference between seeing the refund this year and waiting until next year to receive money that was always yours. Here is the complete action list, everything you need to do before you close this video. For the first change, determine whether your current Medicare Part B premium includes an IRMAA surcharge by reviewing your Social Security award letter or by logging into your My Social Security account at ssa.gov and checking your current benefit and deduction breakdown. If a surcharge is present and your income has decreased since 2024 due to retirement, the death of a spouse, divorce, or any other qualifying life-changing event, download the SSA-44 form from ssa.gov and file it this month. Filing in July gives you the best chance of seeing the premium reduction reflected in your September Social Security deposit. For the second change, log into your My Social Security account at ssa.gov and navigate to your earnings record. Download the complete year-by-year breakdown and review it specifically for years where the earnings listed are lower than you know you were earning or where zero earnings appear for a year when you were employed. If you find a discrepancy, call the SSA at 1-800-772-1213 with whatever documentation you have for that year and file a correction request. For the third change, review your most recently filed federal tax return and confirm that the enhanced standard deduction for taxpayers 65 and older was applied correctly. If it was not, download Form 1040X from irs.gov, complete it to reflect the correct deduction, and mail it to the IRS this month. Filing in July gives you the best chance of receiving any resulting refund before the end of this calendar year. 3 changes, 3 specific actions, each one available to you right now in July in ways that produce a materially better financial outcome than waiting until the fall. Subscribe to Mason Parker USA and turn on the notification bell. Share this video right now with one senior you know who receives Social Security or Medicare and who has never reviewed their earnings record or their Medicare premium breakdown. One conversation this video starts could put real money back in their account before the end of this year. I will see you in the next one.